Hello, everyone. Jeff Dorman, CIO of Arca, here for another edition of Twitter Live, talking about That's Our Two Satoshis. A little shout out to Sasha Fleischman, by the way, who's been with Arca since day one, almost 4 years ago, as our first intern and now a senior portfolio manager. But he came up with the That's Our Two Satoshis name. So we stole that from him, took all the IP, and he gets very little credit for it. So thank you, Sasha, for a great name for the blog that we write. All right, let's dive right into it. Let's talk about the market last week. Pretty clean sweep across the board if you're just looking at average returns. Bitcoin was up 12.5%, pretty much every sector, whether it was smart contract platforms or DeFi, CeFi, Web 3.0. Everything in aggregate went higher. But if you actually looked at the dispersion of prices, it was actually a pretty healthy market again. About half the market was up, half the market was down. It just so happens that the bigger weighted ones from a market cap standpoint were up more than down. So that's why you saw a clean sweep. But it was a Bitcoin dominated week for sure, going for the second straight week. So, we don't talk a lot about Bitcoin here at Arca just because we can't value it. To us, it's a binary option. It's either worth a lot, maybe $1 million a coin, or it's worth very little, close to zero, and everything in between is just a lot of fun to trade. But you can't avoid talking about Bitcoin right now. It is what the market cares about, clearly, with these ETF approvals that are coming tomorrow, paving the way. So what I thought was interesting, though, is we joke sometimes about how if you look at some of the 2017 vintage digital assets that don't really have any product or any product market fit or anything really going for them, but every once in a while they go up because of an exchange listing, and everyone says, "Oh, that's just a Coinbase effect." Well, that's kind of what's happening with Bitcoin right now. Bitcoin just went up 40% in the month, and we're only 18 days into the month, but it's up 40% already, just on effectively an exchange listing, right? We finally got the ETF. What's frustrating about this, and the title of our two Satoshis this week was the huge, kind of not so big deal Bitcoin Futures ETF, is because this is a monumental achievement for an asset that was created out of thin air 12 years ago, to have now a functioning ETF that any brokerage account and any traditional financial advisor can now invest in. But it's bittersweet because while this was a pretty long road for many participants who were filing for ETF applications, the final product kind of sucks. And I say that not lightly. Futures-based ETFs are terrible products. And the reason for that is when you look at a futures curve, futures curves generally trade to dates. So for instance, you'll have a September 30th contract, a December 31st contract, a March 31st contract. And the pricing of these curves is based on a lot of things. It's based on the underlying spot price. It's based on interest rates. It's based on storage costs. In Bitcoin's case, there aren't any, but for other commodities like oil, there are storage costs. Generally, these curves trade in contango, which means the farther out you go, the higher a price you're paying. What that means then, if you're running an ETF that has to have exposure to this, is that you effectively, every 3 months or so, you have to roll. You have to basically pay up for the next contract. So instead of having a standard fee, in this case, I think these ETFs have like a 95 basis point fee, and other ETFs like the S&P have closer to like 20 basis points or 30 basis point fees. In addition to that fee you're paying just for owning it, you're basically also paying a hidden or embedded fee because these products have to roll up to the higher strike every time there is a roll on the calendar. So what this means is that they're horrible tracking stocks. They're not going to move for over a long period of time anywhere close to the underlying. And it's frustrating, right? Because here we have one of the best assets that's ever been created in Bitcoin. There's easy access across tons of different exchanges to get your own Bitcoin. And here we are trying to jam in all of these products that meet the SEC's requirements. And the products across the board have been horrible. I mean, look what has been developed by Wall Street now for the last 3 years. You have passive indexes that do nothing to track the actual digital asset market, right? Half of them have 80% or more exposure to Bitcoin and Ethereum, no DeFi exposure, no Web 3.0 exposure, no NFT gaming exposure. These are not good passive indexes. And yet, that's what was able to get through from a regulation size. What else do we have? We have these other ETFs that are tracking the companies that have to do with blockchain. You have things like BLOK and BLCN. And what do they invest in? They invest in things like Microsoft and JP Morgan. They pitch themselves as ETF tracking funds, but they have nothing to do with as digital asset tracking funds, but they have nothing to do with the underlying digital assets. Then you have things like Grayscale, right? Grayscale was first to market and good for them, but If we all know, GBTC trades at an 18% discount to the underlying Bitcoin that they hold. A terrible constructed product. It's a 2% fee. It's a Hotel California product, meaning you can check in, but you can't check out. You can never actually redeem from your holdings in GBTC. And now we have the Bitcoin Futures ETF. So, it's very frustrating from a market standpoint that we continue to push out terrible products just to appease the old pipes and the old rules and old systems that have been created, 50, 100 years ago. So again, bittersweet. Happy for all of us as Bitcoin investors. Happy to see Bitcoin go higher. Happy to see more adoption. Really would have liked to have seen us get this one right rather than wrong. And we joke sometimes about who the SEC is actually protecting here. It's a joke. We know the SEC has good intentions. We know the SEC is there to protect uninformed investors, but we're getting to a point where sometimes the protections are you wonder who they're actually protecting. And in this case, the CME stock hit an all-time high because the SEC basically handpicked the CME to trade futures for this ETF. And bank stocks hit all-time highs because effectively these are the banks and brokerages are going to be the beneficiary of having this ETF product. So we'll see what happens. Certainly bullish for Bitcoin, not negative, but we may see a lack of real uptick or real adoption of these new products. Separately, switching gears for a second, I want to focus on Tether. Tether and its stablecoin USDT, always under the microscope. A lot of news and information coming out on them. Well, they actually finally settled with the CFTC last week, a $42 million settlement, basically admitting to wrongdoings from 4 years ago that, quite frankly, we already knew because Tether and other agencies already uncovered this. So the takeaway for us is that this is now over. If you continue to see people coming into the market saying, "What about Tether?" or I don't trust digital assets because of Tether. From our standpoint, this is over. Stick a fork in that excuse for not being involved in digital assets. They admitted to wrongdoing. The Tether of 2017 is a very different company than the Tether of 2021. They're transparent. It works. People like using it. It's backed by assets. Whether or not those assets will always be worth 100% depends on market conditions. But in our opinion, there's a lot to regulate and a lot to monitor here on stable coins in general, because effectively these are just unregulated money markets, but it's no longer Tether specific. Whatever standard we're going to hold Tether to, we should be holding USDC and Gemini dollar and Paxos dollar and all of them in the same light, because effectively these are all the same products right now. And finally, last topic that we thought was interesting last week is really trying to get a handle on what are we really trying to accomplish now in the digital asset world versus the traditional world. So, a lot of people in this industry, they grew up in crypto. That's all they care about is crypto. We have people at Arca who don't even own a brokerage account. They don't need it. Everything they do is in crypto. But for a lot of other people in the world, what they know is the bank and brokerage system, and we're trying to figure out how to bridge that gap. In fact, at Arca, one of our core missions is to be that bridge between the traditional finance world and the digital asset world. But it's an interesting thought experiment to think about, in light of this SEC approved ETF, is what if there was no regulations at all? What if the regulators really just left digital assets alone and allowed us to sink or swim on our own accord? It's almost like the movie Sliding Doors, where you could have two completely parallel universes running in tandem, and you get to see how both of them work. So I don't expect us to ever be there. I don't think that we're ever going to get that chance to really see that in action. But it would be interesting. I've been a big advocate of the digital asset transparency that's been happening to date in purely voluntary forms. Where you have companies like Urine Finance and MakerDAO and Aave and Axie Infinity and all these other Nexus Mutual, all these other companies and projects that are self-reporting. They're putting out the information on their own, not because they're being forced to by government regulations, not because they have to file a 10K or a 10Q or because they have to report to sec.gov. They're just voluntarily putting the information out there. On the flip side, when there's a bad actor, you're not waiting for a regulator to shut them down. They're being shut down by crypto Twitter. Look at the OpenSea debacle a few weeks ago when there was front running. Look at Divergent Capital, the venture firm who was Sybil farming Ribbon Finance and basically was asked to leave on their cap table. This industry has done a really good job of self-regulation and self-policing without any actual government intervention. So, if you have a chance to read our blog this week, go down to the third section and read what we wrote there, because I think it would be interesting if we were given the chance to run these two paths in parallel. For those who are looking to read a good book, I would recommend Daniel Pink, who's a behavioral psychologist, wrote a book called To Sell is Human. And what the crux of the argument in the entire book is that there is no such thing anymore of caveat emptor. There's no buyer beware. Mostly because the internet has made that non-existent anymore. Every single buyer in this day and age has just as much, if not more, information than the seller. There's no more used car salesman trying to pull a fast one on you. You, as the buyer going to buy a car, already did the research. You know everything about the car. You're just looking for a salesman that you can trust. So if you think about that for a second, why do we have these rules and regulations? Who are we protecting when the buyer has all the information already anyway? Really, all we're trying to do is build trust. And if you are building trust, who are you going to trust? Are you going to trust governments and banks, or are you going to trust code? And I think the answer is pretty obvious at this point, that most people would prefer to trust computer code than they would local governments and regional banks. So interesting thought experiment. I don't expect that to go anywhere, but for one, I used to read a lot of choose your adventure books growing up. I would choose the adventure of unregulated and just see where it took us. So anyway, we'll see. But for now, that's our two Satoshis. Thanks for chiming in. If you have any questions, please let us know. Otherwise, we'll see you next week.